Okay, after all the lifestyle vlogs, it's time to go back to the purpose of this channel, which is why I called it Finance Nerd. And today I'm gonna tell you about why your money shouldn't sit in your bank account and how you can invest into lowest possible, considered as a risk-free investment. It is US government bonds. It gives a risk-free return on your money and it's highly liquid, which means you can convert it back to your money at your bank account any day, except weekends, unfortunately. So what you need to do, first you need to open a brokerage account, so account with any broker. My recommendation, if you still not have an account, is to open it with Interactive Brokers, and registration link to this broker you can find in the description to this video. Then you need to deposit money into your brokerage account and search for US-T Govt Bonds and choose the one you like. Then you need to buy it for the amount you're comfortable with. And that's actually it. Then you start to receive interest payments and you see how the market value of your bond fluctuates. And currently, as of July 2024, it gives you 4.1% of annual return for a 10 years government bond, which is a risk-free return, just waiting for you to start getting it. 4.1%. How it actually works. So you would feel more comfortable with having one in your investment portfolio. So here you can see one of the bonds I have in my portfolio, and let's walk through and see all the indicators we know about the bond. So first of all, what you need to understand that the bond is equivalent of a debt. If you own a bond, the issuer of that bond owes money to you. And the money which will flow to you as a repayment of a debt are split into two categories. First is interest, and then the whole amount of the bond, the par value, is being repaid upon its maturity, which is the end of the life of the bond. And let's go through what information we can see about the bond. So first, we see its name. It says US Treasury Government Bond, then its coupon rate. Coupon rate is interest rate which this bond pays to you semi-annually. So 4.5%, but this is annual rate. And this is maturity, so the date when the bond will be fully repaid by US government to the owner of that bond at that time. So it's February 15, 2036. So this is the name, and it actually has the almost all information you need to know about the bond. But let's dig deeper. It's important to say that all the market prices, so how much this bond costs now, it is all being defined per each $100 of the bond. So the coupon, which is 4.5%, it is paid per these $100 of the bond. But this $100 of a bond, they have a market value. And as you can see, currently these bonds have a value of $103.56 per every $100 of the debt. So why would you ask someone will want to pay $103 for the debt of $100, which will be paid in 2036? And the answer to this question is the interest rate this coupon is paying and the current market interest rate. And this chart actually represents the current market interest rate for actually this government bond. And as you can see, currently the market rate is 4.12%, which is lower than 4.5%. So these bonds is paying to you higher than the current market rate, and the market rate is changed over time. And this bond actually was issued in 2006. And at the issue of that bond, already this rate 4.5 was defined, and it cannot be changed because the coupon type is fixed. So in 2006, US government needed money and say, I sell the debt, I'll be paying per every $100 of this debt, I'll be paying 4.5% per year. I'll be paying 2 times a year, in February and in August, and I'll repay in full this debt, this $100, I'll pay you back in 2036. So this is 30 years government bond. So they issued that in February 15, 2006. The US government got the money from the first one who bought these US government bonds, and this usually investment banks. And later, US government just took this money and spent for whatever reason they had at that time. And now they just paying the 4.5% semi-annually every year, every February, every August to the owner of this bond at the time. And in 2036, they will repay this $100 to the owner of the bond at that time. But this bond is a marketable security, which means it is tradable on a stock exchange. So after US government sold it to the first buyer of the bond, then the bond started to change hands. And actually it can change hands even every day when market is open, right? So I bought this bond April 18, 2024 from someone. And even now you see I have button sell. I can sell it now to someone as well. So this is a marketable security. It can change hands. You see the history of market interest rate currently. You see it just in April 2024, the market interest rate was almost 6%, right? And currently it is going down. There is another story why it changes. And the most importantly, it changes due to, it's a complex macroeconomic ratio, right? But the Fed interest rate affects this market rate most significantly. If, as currently I hear, there is like 95% chance after yesterday data was released and the inflation is lower than expected, it can probably give the opportunity to the Fed to cut rate, which is currently 5.5%. And I saw the stats that analysts currently say first cut in September this year. So after they will cut the Fed rate, I don't know for how much, but let's say like 0.5%, this effective market rate will immediately drop. Then you see the issuer. The issuer is a country. This is actually why this is a risk-free investment, because the issuer of this bond is United States. The United States of America owes money to you. And bond issuer type government. This issue date, maturity date, it's when they will repay the par value, this $100 of a debt, when they will repay. Until that date, they will just paying you interest on the par value. So through that bonds, US government acquired 26.4 billion US dollars. So this is how they got money, and this is this big story about how much debt US government has, like more than 100% of GDP. But why it's considered as a risk-free investment? Because obviously US government, imagine you have a machine which can print money, and among all other monetary instruments you have, even in the case of your budget deficit, even in case any problems you might have in 2036, when you'll need to repay this amount to all the owners of that bonds, you actually can just print money. You are the only one who has this machine, and your money is the most demanded in the world. So that's why chances that US government will not repay money to the owners of its bonds are the lowest possibly imaginable. Then you can see that initial price of $100 of this debt was $91. And people who bought that in 2006 when it was issued currently can sell it for 103. If someone bought like for 1 billion of these bonds, they bought it with a price of $91, and now it is traded with 3.5% premium, right? So you can imagine it's more than 10% just on the change of a market price of the bond. And they were getting 4.5% every year since 2006 until now to 2024. It is important to understand that this 4.5% is always paid at par value, not this 103, which is changed and which is a market price of the bond, but par value per every $100 of a debt. It means I'll be paid $4.5 per how much of 100 I have in my investment, which is 90. So I'll be paid $4.5 multiplied by 90. This is how much I'll be paid. And here's the table. I just want to show you how this bond works in a little bit another way. So you speak about what is the price of $100 now. So currently the market price is $103.56. This is current market price of this $100. So there is an annual market rate, and it is changed literally every day. You see that now it's 4.12, but just yesterday it was 4.17. This is the coupon payment date. And you see that I build it throughout the very end, the end of this bond. Its maturity is February 15, 2036. Currently, the market interest rate is like this. I just showed that, let's just imagine it's not gonna change, even though it will change every day. So the annual coupon rate, 4.5%, this one, it is really fixed. We can type it, it is fixed. So it will stay until 2036, just 4.5%. And the interest payments they're gonna pay us are calculated in a very easy way. Like per every $100 of a debt, you multiply 4.5% and you divide by 2 because they paid semi-annually and this annual rate. So you'll get like $2.3 per every $100 of a debt every 6 months. And I built it through the very end. So if I hold it until 2036, I'll be getting this $2.3 per every $100 of a bond until the very end, and in the very end they will repay to me last coupon payment 2.3 plus the entire debt amount $100. I want to show you how this market rate is being calculated, how market is defining what is currently the market price for this $100 of a debt. Main driver is this annual market rate. And I'll translate this annual market rate into semi-annual. Right, this is a formula to translate it into semi-annual. It's 2.4. How the market price is being calculated? It is calculated through net present value, which is a formula of discounting all the future cash inflows, the money you get in as interest payments and the par value $100 in the end, discounted at the current market rate. So this is how you define the current market price. You can see that the formula calculated is like 103.97, and the current market price we see actually here, which is how at which price I can sell it literally right now. The difference is because this calculated at the August 15 and currently is July 13. But it just to give you a general sense how it's calculated. And you can see that the closer we look at this row, the closer to the maturity, the lower the price, the market price of this $100 is becoming. This same formula, but just using the outstanding cash flows. And you see that this formula calculates until very end that the market price of $100, which are about to be repaid to you by US government, obviously is $100 as well. This is how it works. If we assume that the market rate will stay same, this is how the market price of a bond will change over time. The closer to maturity, the lower the price. But the tricky thing in a bond market is that if these cash flows you'll be getting into your account are easily to project, they are fixed. The market price of a bond, it depends on the market rate at the time you define the market price. So for example, let's see, if in September this year Fed cutting interest rates and the market annual interest rate is not 4.12 like now, but is like, let's say 3.9, you see that the price is higher now of this bond. It's 105 and it was 103. And the truth is that at some point of time, maybe the Fed will decide that no, inflation is still too high. We need to do a spike again. And let's say the interest rate is 5.5. And you see that it immediately makes the market price of a bond lower than $100. So it means I'll still be getting these interest payments. But if I decide to sell in February 15, 2027 with market rate 5.5, if I decide to sell this bond, the price will be $93, not 103 like now. So I'll lose $10 per every $100. Take into account I have 9,000, I'll lose $900 just on a market price of that bond. Or I can hold it until the very maturity and I'll still be repaid. I will collect all the interest and the final repayment of $100. So do you actually have a choice? Either you can trade, right, the bonds. You can, if you expect that the market rate will go higher, you can sell at this price, right? Before you know it will go higher. You can sell at the price $105. And then after the rate increased, you can buy it again. So your choice, you can either trade the bonds because they like shares, they have a market price, but this market price is affected by the annual market rate. So this is a good actually time to buy the bonds before this is made, before the rates are being cut. But if you have money in your saving accounts, you can easily go and invest into US government bonds because this is considered to be a risk-free investment. As you can see, I already got $600 interest. This is a truly good opportunity now to invest into bonds. Thanks for watching and please subscribe to my channel. Bye bye.